Welcome to Advisor Wars, the podcast where we take a critical look at the key issues facing the financial advisor profession. I am Bob Huebscher, and joining me as co-host is Joe Halpern, Managing Partner and Chief Investment Officer of Obsidian CIO. I was the founder of Advisor Perspectives and led it as its CEO until 2024. This is the 8th episode of Advisor Wars and the second in our series on the role of tax planning in the advisory profession. Our topic today is how long-short strategies can help clients diversify a concentrated position and defer and manage their tax burden. With us is Brent Sullivan, who is the founder of Tax Alpha Insider. He advises family offices and wealthy individuals on this topic. So Brent, I'm going to have you start off by telling us a little bit more about yourself, how you came to be such an expert on tax-related strategies, and a little bit about your firm, Tax Alpha Insider.
Well, it's a pleasure. So thank you for having me. The first thing is my background is really technical engineering and wealth management. And it's an unusual overlap, but more common nowadays. And so if you are the type of person who enjoys opening up machines and figuring out how they work and really tearing them apart down to first principles, then I think tax management is a good fit for your personality. And so that's just a passion I discovered over time as I was just like, wow, I can just keep on digging here. And there are mechanical things that are just like impossible to look past. And if you like the engineering aspect of just thinking, then tax management is a good fit because it's all very mechanical. Sometimes there's gray space, but it's pretty mechanical.
That's great. Thanks, Brent. We are going to focus on long-short overlay strategies today. Before we dig in, can you give us an overview of the range of solutions for concentrated positions, including direct indexing, exchange funds, Section 351 ETFs, and how long-short strategies are positioned relative to those offerings? It probably helps, Brent, if you don't mind, to give a really fast definition for our listeners of long-short before going into that.
Sure. Okay. So the pantheon of single stock de-risking solutions, there are many. I'll start with long short, just to explain how it works, and we can kind of punch through the rest of them there. I've got a list of close to 20. I won't go through all 20. We'd be here all day. But a long short strategy. So imagine that you have a concentrated public stock position, and imagine it's a big tech company that is appreciated significantly, and you contribute that single position into a typical brokerage account, and you have an advisor, and the advisor grants third-party authorization, trade authorization, to affect transactions in that portfolio. Then a third-party manager would use the position as collateral. They would add a margin loan on top. The margin loan can be small, it can be really big, and then they would match a corresponding short position on, it's actually a short portfolio on the single position. So the net gross exposure would be margin plus the concentrated position plus all the short positions. And so the margin, that's a full portfolio. It could be hundreds of securities, and same with the shorts. It could be 50 to hundreds of securities. And so you have the concentrated position and you have these overlays on top of it. And what's going to happen is ideally the solution generates pre-tax alpha. So this is a relative value strategy, approximately relative value. The longs hopefully outperform the shorts. Shorts don't have to go down. They just have to underperform the longs. And so hopefully you're getting pre-tax alpha there as a primary concern. As a secondary concern, as the market is bouncing around, you can tax loss harvest in the long slice of the portfolio, the margin portfolio, and you can tax loss harvest in the short portfolio. And there are technical concerns there and technical interesting bits there, but as you're harvesting losses, generating pre-tax alpha, you can hopefully unwind the concentrated position in a tax neutral and very thoughtful, risk-minded way. Another interesting aspect of the shorts is they can be used to hedge some of the sector exposure in the concentrated position. So if you've contributed a tech stock, you can short a lot of tech to be able to manage risk also while you're putting on this trade. You cannot get rid of all that idiosyncratic risk in the individual name, but you can try to remove some of the risk just from that short overlay. So those are the mechanics. That's the basic structure of a long-short overlay on a concentrated position. But I'll keep going here. There are other solutions. I won't go in as much detail on the other ones, but in the rest of the solutions for concentrated stock, let's start all the way at the beginning. If you have something like direct indexing says that you have a diversified portfolio of individual stocks, could be stocks or bonds, and as the market is bouncing around, you harvest losses. You use those losses to offset the long-term appreciation in the concentrated stock, and you try to move out of that concentrated position in a thoughtful way over time in a tax neutral. That's direct indexing. We already talked about long short. Another solution is the exchange fund. So you could take a concentrated position, you could contribute it to a partnership via Section 721. In the partnership, hopefully others are arriving with different positions such that once the fund closes for additional contributions, you more or less get diversified, economically diversified. There's a tax definition in there, but economically diversified. So that's a concentrated to diversified-ish exposure using the exchange fund. And then if we flip over to public vehicles, we can talk about a 351 contribution to a new ETF. So that would be, you have to contribute a diversified portfolio now. So your concentrated public stock would have to have buffer assets around it that are already diversified. So you have to satisfy those diversification limits. You could transfer the entire portfolio into a newly launching ETF. That's a way to improve diversification. You're technically already diversified in that case. And that can be a useful way to reallocate. There are other solutions. There's a whole strata of options solutions, including an exchange fund replication strategy using options. There's a covered call. There's a caller. You could use OTC structures like a variable prepaid forward that extracts cash out of the concentrated position. There's also gifting solutions. There's always the qualified opportunity fund to the extent that that's relevant for the overall holistic exposure. But I just punched through all of them very quickly. Hopefully that's good enough for now.
Yeah, I want to do like one takeaway there is big picture. I think you mentioned right when you started, there's a good 20 of them. There are so many solutions available nowadays for clients of advisors to assist in all these matters. It's so important for people to focus on it. So just want to highlight that. Thank you, Brent.
Yeah. And Brent, you did a great job explaining what how the long short strategy operates. But just to make sure I understand the key difference between it and Section 351 or exchange funds or even direct indexing, the key difference is that you're able to harvest losses from both the long and the short side of the portfolio. So that gives you a greater opportunity set for diversifying whatever that concentrated position is. Am I correct in that understanding?
Yeah, there's two different things. The first is that it's an alpha seeking strategy. So hopefully the portfolio is performing and giving you that little alpha buffer too. That's oftentimes different from a lot of the other solutions, which are not alpha seeking. So that's the first thing. It's an alpha seeking strategy. Hopefully you get some buffer there. And then the second thing is that, yeah, you're going to be able to harvest losses in the long slice of the portfolio. And until basis fully depletes, every time you harvest losses, basis goes down. But the short exposure is different. Shorts don't technically have basis. What they have is a different flavor of exposure that has unlimited risk. And that unlimited risk, in theory, has the potential for unlimited tax loss harvesting. The market goes up, the shorts lose money, you harvest. The market goes up, shorts lose money, you harvest. There's a little cycle there. And so it's the perpetual losses that come from the shorts that are interesting, technically interesting. But really the first concern is does the alpha make sense in these strategies? And then you get all these tax attributes after that.
So could you, I understand that key advantage of that long short portfolio is that it may provide opportunities for tax loss harvesting as compared to direct indexing, but could you explain more of that element?
Yeah, so I think of it's almost maybe like one illustration is like a fishing net. And so with long short strategies, you're essentially casting a far larger fishing net into the water and you're dragging the net through, and imagine that each one of the fish that you catch is like a little tax loss harvesting opportunity. And so with direct indexing, your gross exposure is 100%. You contribute $1, you have $1 to harvest, plus or minus, assuming no appreciation. So you have $1 to harvest. But with gross exposure, with long and short, you could really turn that $1 exposure into many, many dollars exposure. So it's quite common for gross exposure to get to, let's say, 200, 100. And so that would be 300 gross exposure. So instead of $1 of exposure, you have $3 of exposure. And I've seen quite a bit higher than that also. I think I won't say the highest I've seen. I have one case that's really wild, but 300, 200 is somewhat common in certain situations, very extreme situations, but it does happen. So that would be 500% gross exposure. So again, if you think about this net that we're dragging through the water trying to catch fish, the fish are tax loss harvesting opportunities. That's just a much larger net that you are dragging through the water. And it's an interesting surface area type analogy that I'm making, where the bigger the net, the more opportunities there typically are.
You mentioned that the long-short strategy depends in part on alpha generation. How critical is that alpha generation to the overall success of the strategy?
I think it's really meaningful, and it's because long-short strategies are very expensive in the following ways. So one, manager fees are higher. These portfolios take extra competency to deliver, and it's really around the stewardship of short positions. It just takes really, really special knowledge, and it really takes additional competency beyond long exposure. We can talk about that in a little bit, and this is like sort of front of mind right now with everything that's going on at the custodial layer and with some short squeeze elements, but it really does require specialty. So the manager fee is going to be higher. The second thing is that you have financing costs. Margin is not free. Margin comes from somewhere, and it's a raw cost in the portfolio. That cost is mitigated by what's called short rebate, which is the amount of interest paid on short proceeds that are held in an account and that generate interest income. Those two net with each other, but we are talking about financing costs through the middle of something like very, very roughly 100 basis points. It scales with the amount of leverage, and it oftentimes can get much lower. Sometimes it's much higher, but 100 basis points, 80 basis points, something like that. That's rule of thumb. And again, it scales with the amount of leverage. The next thing is that these portfolio strategies trade a lot, and trading is not free. I think most folks forget that, yes, Robinhood does not, allows free trading, but you still are paying bid ask on that at the very minimal. And then, so those are some of the costs that are embedded in the portfolio. So how important is alpha? It's necessary. Alpha must help overcome all of the substantial operational costs that are baked into this strategy. So I think a pure post-tax argument for long short is it's missing the mark in a certain way. I mean, the costs in the portfolio effectively are very high, and alpha really needs to help mitigate that.
So you touched on the costs, and I'd say those costs is a risk there. Could you speak about other risks in the long short strategy and if there's any ways for an RIA to mitigate those risks?
Yeah, so I've been thinking about this a lot lately. I think what the RIA can do is they need to be very diligent during the manager selection process. And I believe that is all that they can really do. When you're selecting a manager that has this competency, you're really trusting not only their alpha generation capabilities and their tax prowess, but you're also testing their risk management capabilities. And to a certain extent, it does not make sense for the RIA to be backseat driving a manager who is like a risk professional, who is a specialist, who understands really the portfolio specifics and all the gnarly details from just operating the portfolios on a daily basis. So what the manager can do is really turn the screws what the advisor can do is really turn the screws during manager diligence and just understand the risk profile of a long short strategy. It is well beyond typical long only implementation. And I think there are a bunch of different strata of what can go wrong. And there's a lot that can go right, but there's also just new stuff that an advisor needs to be aware of when they're considering a partner in long short world. It really does take specialized experience and expertise. It's a novel way of managing money.
So what are some of the best practices? What are some of the key elements for a successful due diligence process for an advisor?
Yeah, and this is really where I spend a lot of time, is trying to figure out how do we make decisions about whom to work with based on a number of things, but I always think about track record. Like, have they been through this before? Not just performance, but also just operational competency. Anyone who's got specific expertise managing short positions in particular, that's worth quite a bit in this world. The reason is shorts are just so gnarly. They have really some unique properties that are unparalleled. It's an asymmetric type exposure. So for example, like in short positions, we can go through what's called a squeeze. Squeeze is when essentially prices rise in a short name, and then others are forced to close the position. They're forced to buy to cover, and they have to do that to meet margin requirements. That's interesting. That's pushing the price up. So now everybody's losing money on the short positions. But if things get really dire, then what can happen, it's very rare, but it does happen, is that the position can get recalled by the lender. And so the lender is saying like, oh, I've got this name, I've got it lent out right now. Hey, I want it back. And if the portfolio manager or the lending agent cannot source a replacement, then that position just gets closed. And like at times that can be like a really adverse scenario. Now, again, this is very rare, and there are ways for managers to avoid circumstances like this. But those are the kind of questions, those are the risks that I think about. And those are the kind of things that I like to put in front of the managers and just ask them how they handle it. Have they even thought about it? Look at their body language when you put a question in front of them. Are they puzzled? Like, whoa, we haven't even thought about that. That's a red flag. I mean, like short positions are so gnarly in this context. And again, unlimited risk. It's not the same as a long position where you can lose 100% of the stock. This is unlimited. And so that's a really unique place to be. So anyway, short exposure is a whole thing. Experience also matters in this world because just routine stuff that's so weird with short positions. Corporate actions. How does this even work? Performance reporting is like you sort of dialed in at this point, but I think if you asked an RIA, off the street, like how do you calculate, total return on a short position, they'd really have to like think about it for a couple of minutes. It's sort of like non-trivial. You have to do like a little bit of extra thinking to figure out how this stuff works. And so I think that probably make sure that you as an advisor understand what you are getting your clients into first. And then really do the best you can to make sure that you've chosen the right manager. And then from the outside, also understand that the custodian lender also has just a lot of unilateral power in this world. And so they get to decide the haircut that is applied to collateral assets. They get to decide lending rates. All of those things are really asymmetric and unnotified. They can make those changes overnight. And so just realize all of the exposure that you are and risk that you are introducing into your client's exposure, and just be aware of those things. Finally, I know I keep going on and on here, but finally, these strategies are unique. They have leverage embedded into them. And sometimes folks don't want to hold that leverage. So you need to have a thoughtful way to de-risk the portfolio. You could decrease leverage. You could also come up with estate solutions such that you transfer the entire portfolio to the next generation. These are all just the thoughtful things that you have to do up front. And long short sort of forces us to do that work up front instead of thinking about it down the road.
So you talked about exchange funds, Section 351 ETFs. What are the situations where the long short strategy really makes sense versus those other alternatives? And are there situations where it clearly does not make sense?
Yeah, I mean, so it's a nuanced question, but I'll try to be brief about it. So long short is really the most flexible solution. It's a fully customized answer that is delivered at the very individual household level. And so you don't have that flexibility with a 351. That's a in-kind contribution to an ETF, or a 721 like an exchange fund. You have no personalization opportunities there. So what does personalization mean with long short? Well, it means that if you kind of like the concentrated stock that you contributed and you're like, I want to maintain some outsized exposure to it, then that's an option. You have much more dials that you can use. Another thing is like if liquidity is a concern in the near term, long short does allow you to extract liquidity from the portfolio if you're interested in it. That's not the same with with an exchange fund. It's just a bit different. Oftentimes you can extract liquidity. There might be fees attached to it, but it's just a different paradigm. It's a unique solution that gives you just like a ton of flexibility and customization opportunities. When does an exchange fund make sense? Like we have a really unique planning environment in Washington State where I live, and if long short is less effective at the state level, And there's a technical reason for that, but let's just suffice to say that if it's less effective at the state level, then something like an indefinite deferral solution, like an exchange fund, like a 351, maybe options overlays to a certain extent could make sense. So I'm always thinking federal and state. It really depends on the jurisdiction that the person is operating in. But those are the things that are kind of going through my mind when I'm thinking about different solutions.
And how do you explain these strategies, these long, short strategies to clients without overwhelming them? I mean, they are quite complex.
Well, I mean, yeah. So luckily, I'm a corporate consultant, which is a great joy. I get to work with tacticians all day long. So usually I'm getting informed on specifics that are just as I dig into it. But I think that I have a multifamily office friend in Florida who describes it as the complexity ratio. How much tolerance for complexity does the client have when he's doing those communications with them? And how do you explain it? I think there's a certain personality in a client that wants to understand how these things work, and they really feel camaraderie with the advisor who can competently explain like each layer of risk and the mechanics, and just like, wow, this is so nerdy and cool, interesting. Like, have we thought about all the risk? And they really want to partner up on that. That's a subset. And then there's another subset, which is like, okay, yeah, cool, I trust you. Let's not, the risk is in your court, essentially. If this goes south, I'm more or less holding you responsible as the advisor. And then there's a certain set that is just like really uninterested in the daisy chain of activities that need to happen to affect this strategy in their portfolios. So it's really about mapping the strategy, again, to the client always, and their tolerance for risk and their interest in learning as much as they want. And then for the advisor, it's about being able to deliver on that interest from their client. If the client wants to be nerdy, like, you must enable their nerdiness by really pulling the thread on the sweater as much as you can. It's a fascinating technical challenge, but I think that some clients will really appreciate it.
Do you see what are the most common objections, whether it's a client of yours, maybe more institutional level, or at that retail level?
I mean, some folks probably the biggest thing that comes up is the alpha model. So this is, a fascinating development in the marketplace has been just a reemergence of alpha as a topic of conversation. I think like 50 years ago, the way to choose investments was to select the best manager. Who's got the most alpha? Like, how does this work? Let's choose the best manager. And then the entire market kind of swung into passive territory for a while. And then we had passive with tax alpha, with tax loss harvesting, things like that. And now the pendulum just like keeps on swinging into active territory again. And that's what long short really brings to the fore right in the initial discussions. How do you generate alpha? These strategies are expensive. So we have to make sure that we have a competent manager behind the scenes who is doing something interesting, because alpha is scarce. And so I think that conversation is happening a lot more now.
Overall, successful have long short strategies been based on your experience? And have you seen any really big mistakes that have been made?
So, I mean, one of the mistakes is not at the manager level, it's actually at the advisor level, is just like getting really excited about the strategy and not appreciating the cost. So that's the first thing. Again, these strategies are expensive. We talked about that earlier, but also the suitability for the client. And so, like, does the client have a substantial need for the strategy? And then also figuring out like how much leverage should they embed in the strategy and how long are they going to hold the leverage? I think that there's really just there's like a lot of emphasis on the tax benefits. And I think the right way to describe it is the tax fringe benefits. And so the fringe is on the edge. It's the gravy. It's not the potato. And so I think that the alpha is actually the potato. And so folks are getting really distracted by the gravy. And I think that's one thing that I would like to see just tamp down a little bit. Let's get back to alpha and manager selection as a pre-tax concern, and let's collect those fringe benefits, but also just know how much risk is embedded in the portfolios just as a nature of the shorts, but primarily as a function of the model that the manager is rolling. So that's one thing that I see. Another thing is that, folks sometimes will recommend this strategy when it doesn't make sense in the jurisdiction. So again, Washington State, we have a really interesting capital gains regime up here, just as a case study. And, it makes sense federally at the state level, but at the state level, it's a partial solution. And I think that it just makes sense to be very, very thoughtful advisor to client if this strategy makes sense and it achieves the objectives that they have behind the scenes. Operationally, at the manager level, the solutions are so heterogeneous, like the outcomes for clients are so heterogeneous that it's really hard to say if there's been any real screw ups there. And if they are, they're not telling me about them, but I'm sure things are happening and it's scrappy behind the scenes. But in general, so it's great. I mean, I'm like a somewhat public personality. And so people are telling me, so advisors communicate to me with some regularity about what's happening in the portfolios. And it's all over the map. Sometimes some have a marginally bad experience. And for the most part, the portfolios are highly diversified on the longs and the shorts. And they're really, it's a very popular strategy for a reason. It seems to be quite effective when competently administered.
Yeah, so Brent, I want to highlight, those comments. You mentioned yourself in the beginning of the show, you're an engineer a bit, you like to tinker with it. And I find advisors get very excited about the concept. And it's so important because these are long-term strategies, same as 351s, same as all the rest, but they're long-term strategies. So why are you using them? What are you trying to accomplish? It's so important to ask those questions. So thank you on that. I want to just broaden out a little bit. What trends are you seeing shaping the future of tax management for RIAs? And what solutions out there are likely to gain traction over the next few years?
I think long short's going to keep growing. As just one example, the custody lending layer, we're going to see more lenders come online, maybe deeper integration with or direct solutions from prime brokerage, which is just a different pool of assets. So I think the long short will keep growing as managers come online and advisors are excited about it and it makes sense for their clients. So yeah, that's a very interesting development. I think there's a ton of innovation in ETFs right now. And ETFs are it's like an interesting wrapper, right? I mean, it's just a lot of interesting stuff. I'm not talking about like the next new equity fund coming to market. I'm really talking about oftentimes unique solutions or unique strategies delivered in the ETF wrapper. And so a lot of stuff with options in the ETF wrapper is pretty interesting to me nowadays. I would say that like the thing that's interesting for advisors and the questions that I'm asking managers now are usually around economic substance. So yes, it's great that you can do some crazy tax thing in the ETF wrapper, but really, I think we need another layer of defensibility there. So I think managers need to start proving that the solution really has business purpose. It is materially changing the economic circumstances of the investor, and really start defending substance if they're going to get creative from a tax perspective. So I do see a lot of cool stuff happening, technically cool, in the ETF wrapper, but now I'm asking about economic substance all the time.
Really interesting. I understand that you are hosting a conference on tax strategies in Seattle, where you are based. Tell us a little bit about the conference and what attendees can expect to learn.
So Basis Northwest is the inaugural event. It's a taxable wealth innovation event. And we've got folks from across the country coming to Seattle to talk about tax planning in a thoughtful way. And I think it surprises folks. I'm very research oriented. I like reading peer reviewed publications. I like math papers, things like that. And so that's my bent on the event is bring the nerdiness, bring the mechanics, bring the substance. And so that's it should be a good time. We're nearly sold out. So we got 211. Hopefully we'll get to 215 soon. And then that's it. The fire code says no more people in the building. And hopefully it'll just be 2 days of innovation and thoughtful portfolio design and really next level planning for end principal wealth holders.
I was looking at the agenda for it this morning. You sent it out in one of your daily emails, which I encourage people to sign up for. And you've got some great speakers there, Meb Faber, Rob Arnott, quite a few other names that I recognize. So I think it'll be a terrific conference. Last question here. In a minute or less, what is the key lesson that RIAs should take away when it comes to long-short strategies?
Understand the risk. Understand what it is first. It is an alpha strategy. Understand how the manager generates alpha, understand how much it costs, and then lastly, understand the unique risk profile of short positions.
Well, thank you very much, Brent. And thank you for listening to Advisor Wars with Bob Huebscher and Joe Halpern, and today featuring Brent Sullivan. To learn more about Obsidian CIO and Joe's work, we'll include his contact information and a link to the firm's website in the show notes. And you can also find Advisor Wars on Apple Podcasts, Spotify, and YouTube, and we will include a link to connect with Obsidian on LinkedIn. Stay tuned for our next episode in our series on tax management when we discuss the operational playbook, workflows, client conversations, custodial coordination, and building repeatable tax-aware processes. Thank you.
Obsidian CIO sponsors the podcast to further education and critical thinking about the factors that affect markets and investing. And the podcast does not provide investment advice. Investment advice is offered only to clients of Obsidian CIO who have entered into an advisory agreement and with whom Obsidian CIO has identified individual objectives, risk tolerance, and other investment needs.